So the way that the Fed changes the money supply is through open market operations. So there's two different things they can do. They can either engage in an open market purchase, which is when the Fed buys securities from banks. And when the Fed buys securities from banks, when we're talking about securities, we're talking about treasury securities. So basically treasury securities are debt that the government has issued. So like if you have a savings bond or an I bond or just treasury securities in general, those are debt that the government has issued. And so the Fed can buy those securities from banks. Banks hold those securities because they're a really safe investment. And so if the Fed buys the securities from the bank, the security is going to go from the bank to the Fed, but the Fed is going to give the bank money. So now the banks have more money to lend out. So they've injected money into the economy. So when you see the Fed making an open market purchase, they're buying securities, that's increasing the money in the banking system. So the alternative is an open market sale. And an open market sale is when the Fed sells securities to banks. And when the Fed sells securities to banks, that means the the bank is going to buy the security. So the bank is going to give the Fed money. So now the banks have less money to lend. Okay, so there's less money in the banking system. So if we extend that to the money multiplier, so let's say in this example, our required reserve rate is 5%. So the Fed buys $10 billion worth of securities. That's an open market purchase. Okay, so the Fed buys the securities. So we want to figure out what's going to happen to the money supply. So the money multiplier, remember, we're going to do 1 over the required reserve rate. So if we translate 5% into a decimal, that's 0.05. So 1 over 0.05 is 20. So we multiply the change in the security purchase, which was 100 billion, and then we're multiplying that by the money multiplier, which is 20. So that's going to be 2,000 billion or $2 trillion worth of increase in money. So on the alternative side, if the Fed sells $50 billion in securities, that's an open market sale. So what's then going to happen? Okay, so in this case, still the money multiplier is going to be 20 because 1 over 0.05 is 20. So now, because the Fed is selling the securities, that means the banks are going to have less money in their ability to lend out. So 50 billion times the 20 is going to be a $1,000 billion decrease in the money available to lend out. So that's going to be a decrease. Whenever the Fed sells securities, that's a decrease in the money supply.